Perfect. So good morning, everyone, and welcome to our small business webinar on tax preparation. My name is Hurik, and I work for our economic development department here with the city of Glendale. As part of my responsibilities, I make sure that our small business community is well connected with up-to-date information and resources, so that way they become successful. I'd like to thank Pace, who helped me put this webinar together. Vartuli is unable to attend this morning, but she's been wonderful to work with. With that said, I'd like to turn it over to Bella Wang. She is CPA from Wynn's accounting firm, and she'll kick off today's webinar.
Thank you. Good morning, everyone. So I prepared a PowerPoint presentation. So today I'm going to just briefly talk about some tax planning, the structure for small business. So let me go ahead and share my screen first so we can get that taken care. So my name is Bella Wang. I'm the tax partner at Wynn's. We are headquartered in Long Beach. We have another office in Irvine. We have total 200 people, consider ourselves as a mid-sized CPA firm. We do audit, tax, and employee benefit services. So I've been with the firm for 23 years, in public accounting for 26 years. And I work with a lot of small, mid-sized business. And today I'm just going to talk about some of the things you should consider from the tax perspective. So let me go ahead and get started. So here's my agenda for today's presentation. I'm going to talk about the choice of entity. Depending on what kind of entity you have, there will be a different income tax implication. And also, when you start a new entity, a business entity, what accounting method you should choose, and importantly, what accounting software you should have. And I also get this question a lot, like, we have a small business, they want to hire some family member, what are the issues, something they have to consider, and also some retirement plan consideration for tax saving purposes, and some incentive available for the small business. And since this is a workshop, feel free to put your question in the chat room or stop me at any time. Unmute yourself and stop me at any time if any question pop up, so we can make this more interactive. So let me start with choice of entity. So when you start a business, you can choose to have your business as a C corporation, S corporation, or a partnership. The partnership can be a limited partnership, general partnership, or limited liability company. So let's say you start your company as a C corporation. So the C corporation, all the income that was earned by the C corporation is separate from your personal return. Right now, the federal tax rate for C corporation is at 21%. Effective 1/1/2028, they reduced the C corp tax rate from 35% to 21%. California tax rate is 8.84. However, there's some disadvantage of having a C corporation is that C corporation have a double taxation issue. So if you have a C corporation, let's say if the corporation make $10,000 taxable income profit, you have to pay the corporate tax, 21% federal, 8.84 California. You have to pay the tax on the income, and then when you take dividend out, you have to pay another tax at the personal level on the dividend income. So that's the disadvantage of having a C corporation. When we talk about S corporation or partnership, you don't have double taxation for those type of entities. For C corporation, you do have a liability protection. So because it was separate entity, if you get involved in a lawsuit, if the business getting involved in a lawsuit, the plaintiff, the person who sue you, can only go after the asset inside of the C corporation. The big advantage of having a C corporation is that if you end up selling your C corp stock, you get this qualified small business exclusion, which means that you can exclude up to $10 million or 10 times your basis in the C corp stock for federal income tax purposes. So if you sold your C Corp stock with a significant amount of capital gain, you may have a very large tax benefit if you have a C Corp stock. The other disadvantage is that if you have a C Corp stock, when you take out dividend, it's subject to that 3.8% net income investment income tax. The other type of entity is the S corporation. So to make your company as a S corporation, you just need to make an S election. You can make the S election effective day as the same day as you incorporate your company, your corporation, or you can make that S election later on. So the benefit of having an S corporation is that there's no double tax. At the federal level, the S corporation does not pay any corporate tax. For California, you do have the 1.5% S corp tax on the net income. The income will flow to the shareholder. The income will be reported on the Schedule K-1. So every year, the shareholder will get a K-1 from the S corporation. They will pay personal income tax on the S corp income. And also, if the shareholder is active, materially participate in the S corp activity, you don't have to pay the 3.8% net investment income tax on the S corp income. However, there's also additional rule you have to consider. If there's a loss from the S corporation, you need to make sure that you have the enough basis to take a loss. And also, if you're not actively participate in the S corp activity, your loss from the S corp will be subject to this passive loss limitation. The other benefit of having an S corporation is you also, if it's a qualified business, I mean, it's not any specified service business, then you can get 20% federal tax deduction on your share of the S corp income. The other entity you can have is the partnership, including the limited liability company. So a lot of small business client I have, they have a LLC for the business. You can have a single member LLC. That means the LLC have only one owner, or you can have multiple owner of LLC. If you are a single member LLC, that means you are the sole owner of the LLC. You don't have to file a separate business return for the LLC. It's disregarded for income tax reporting purposes. For California, you do have to file a short Form 568 because California requires you to pay $800 minimum tax and also the annual LLC fee if your gross receipt exceeds certain amount. So for California, you don't have to file a Form 568 for your single member LLC, but for federal, you don't have to do a separate filing for your single member LLC. If you have two or more owners in the LLC, you do have to file a separate return for the LLC. And the LLC operates the same way as the S corporation. There's no double taxation. All the owner will, the income from the LLC will get reported on the K-1, and the owner, the member of the LLC, will include the K-1 income on their personal return. So this is the LLC fee that I just mentioned. So every LLC registered to do business in California, they have to pay the $800 annual minimum tax. And if the gross receipt exceeds certain amount if the gross receipt exceeds $250,000, so between $250,000 to $499,000, almost $500,000, then that's $900 LLC fee. And between $500,000 to $1 million, that's $2,500. Between $1 million to $5 million, that's $6,000. If you have more than $5 million, it's $11,790. Keep in mind, this is on the gross receipt without deducting any cost of your business expenses, your cost of goods sold, or any business expenses. So even the business has an overall net loss, you may still subject to the LLC fee if your gross receipt exceeds the threshold. Next, I'm going to talk about the accounting method. I feel like for a lot of small business, it's really important to understand what's the income tax implication based on the accounting method you choose. Most of the small business, I would say, would choose cash method. That means you only need to pay tax on the income you collected in cash. So it's all purely cash method. you don't have to worry about your accounts receivable that, you already sent an invoice to your customer, you haven't get the cash yet, you don't have to pay tax on that. Of course, when you get to the year end, I have some cash basis clients. They always say, well, I received a check from my customer on December 30. I just put it in the drawer, so not put it in my bank account, and I don't have to pay a tax this year. Technically, that's not a correct way, because if you receive the check from your customer on December 30, you have the possession, you have the check in your hand, even though you didn't deposit that to your bank account, that still is considered income to you. We do have a limit, say, if your gross receipt is over, it's actually now $26 million now. If your gross receipt is over $26 million, then you cannot use cash method. You have to continue to you have to switch to accrue method. However, there's an exemption for professional services corporation. So if you are you're a service corporation, even your gross receipt is over 26 million, you can still use cash method. But some business, even small business, if they prefer, they can use accrue method. So the difference between cash method and accrue method is that the accrue method, you recognize income when it's earned, even though you haven't received the payment yet. So, for example, if you are selling widgets and you already shipped the product to your customer, they haven't received it yet, and you have a 30-day term with your customer, so they're not going to pay you until 30 days later. If you are using a accrue method, then you do have to recognize the income when the product is shipped to your customer. And then for expenses, you accrue the expenses when the service is received or when the event happens. So, for example, if you have a vendor or a service provider, they will provide the service to you before end of the year, let's say on December 20. Even though you have not yet received the invoice from them, you haven't paid for the service. If you are accrue method, then you have to accrue that expenses in that year, and you can get a deduction for it. Usually, if you have what's called the review, compile financial statement or other financial statement, and that means must be the financial statement must be reported under generally accepted accounting principle GAAP, then you have to use accrue method. Cash method is not allowed under GAAP. We have a lot of clients, they have a loan with the bank, and if you have a loan with the bank, typically they will require a compile financial statement or review other financial statement from CPA, then we have to report a financial statement on GAAP basis, and that we have to use accrue method. So, for example, just kind of to go over the example, if you use cash method, you receive $10,000 from your customer for selling the product to them. Once you have that check on hand, then you have to recognize income. But you don't have to recognize income if you just ship the product, you haven't received the check yet. That's for cash method. For accrue method, if you already shipped the product according to your term with your customer, if the product wants to ship, then that's when you complete the sale, then you have to record that as an income in that year when the product is shipped, even though you haven't received the payment from your customer. I'm going to just go over the accounting software, and most of our clients, they use QuickBooks, and there's a lot of feature in QuickBooks. I know one of our attendees, she's a QuickBooks expert. So even you're a small business, I really encourage you to have a accounting file set up so you can properly keep track of your business income and expenses. I know when you're small, you probably just say, I have a client like, I just started my business, I'm just using an Excel. I keep track of all my income, all my expenses in Excel. I use my personal bank account. I always say, it's not the best practice. I think I definitely recommend you should have a separate bank account set up for your business and use accounting software to keep track of your business income and expenses. And I apologize, I realize there's a typo in there. It's easy to set up, not easy to set up. So QuickBooks, and there's a lot of feature in QuickBooks. I'm not a QuickBooks expert, but I know you can do a lot of like automate payment. You can do a bill pay. You can process the payroll. If you only have 3 employees, you can link directly with your bank account, so you can print your financial statement, your balance sheet, your income statement timely from QuickBooks. Again, my recommendation for a small business owner, you should have a very good set of book and record, so you know if you are making money or not, right? So you have your business, and the purpose, the reason you set up your own business is you're an entrepreneur, you want to be successful, and in order to know whether you are successful or not, or you're on the right track, is that you gotta have a good set of accounting, a good book and record to know if you are on the right track with your business. There's another, I have another slide here. I'm not just gonna go into too much detail. We have some clients use this, but I think this is kind of when you are growing, when you're getting bigger, QuickBooks is not really fitting to your business model, then there's a lot of other accounting software out there you can consider. I also work with a lot of clients in other countries. In Europe, I know they use Xero. In Australia, they use different software. So again, but in US, most people use QuickBooks, and if you need help, I think you can reach out to a lot of QuickBooks experts out there. They can help you to set it up. Next, I'm going to talk about the owner employee compensation, and if you are want to hire one of your family member, what are the tax issue or anything you need to consider. So when you are when you work for your own company, you have to take out a reasonable salary. So earlier during the presentation, I talk about different business entity type you can have. So if you want to avoid the double taxation, you can have an S corporation or a LLC. The biggest difference between, and assuming you are actually participating in your business, you are the owner, you monitor, you manage your daily operation. So the biggest difference between S corporation and the LLC is, if you are active owner of the LLC, all the income from the LLC is subject to the self-employment tax. So the self-employment tax is at 15.3%. That includes the Social Security tax and Medicare tax. There's an income limit for the Social Security tax, but there's no income limit for the Medicare tax. So I have a lot of clients, they set up a company as an LLC. When the company start making money, start growing, the LLC, let's say they have $1 million of net taxable income, they have to pay 15.3% self-employment tax on the LLC income, which is in addition to the income tax. So if you have to pay just at the federal level, assuming you get this, the 20% deduction I talked about earlier, and you are at the maximum federal tax rate, let's say it's 30% on your LLC income, that's just on the income tax. So if you add the 30% income tax plus the 15.3% tax, then just at the federal level, just for federal, you're already paying like 40 or 45% tax. So that's a lot of taxes to pay for a small business owner. So so sometimes you say you're not may be so tax beneficial to have a LLC because the self-employment tax. But if you have an S corporation, you don't have to pay self-employment tax on the S corp income. So you only pay payroll taxes, which is also the Social Security tax, the Medicare tax, on the salary you take out from the S corporation. So of course, there's still other difference between the LLC and S corporation. There are more limitations on the S corporation. For example, you cannot have a foreign owner in the S corporation. If you are the shareholder in the S corporation, all your income, your distribution, your dividend distribution has to make pro rata based on the ownership percentage. There's more flexibility on the LLC. But if you are just a 100% owner or two owner, everything is pretty straightforward. From saving the self-employment tax standpoint, it may be more beneficial for you to have an S corporation. So like I said, you don't have to pay at least as of today, you don't have to pay self-employment tax on the S corp income. That may get changed later. I know it's always in the discussion. People think that it's kind of like a loophole that the S corp shareholder doesn't have to pay self-employment tax on the S corp income. But now you don't have to pay self-employment tax on your share of the S corp income, so it's more beneficial to have an S corporation if you don't have to worry about the other flexibility that LLC can offer you. But you also, if you are the owner of the S corporation, you do work for the company. You keep that in mind. You do need to take out a reasonable salary, because if you get audited, if you don't take out any salary from your S corporation, and if you get audited, the IRS will say, well, you're trying to avoid the payroll taxes by not paying yourself a reasonable salary, and that can be a problem. So if you're considering hiring a family member, let's say you have a teenager kid that want to have a kind of pay them part-time or during summer, they work for the company, and you want to kind of say, how much should I pay for my kids to work for me? Again, you have to be reasonable. You cannot have say, again, if you have young kids, it depends on whether there's also a provision in the tax code called kiddie tax. So if your kids is subject to the kiddie tax, it may not offer a great tax saving for you by paying the kids, because the income received by your kids will be taxed at the same rate as you. But if there's no kiddie tax, sometimes it's tax advantage to pay your kids for working for you, because their tax rate is lower than your tax rate. However, you need to be reasonable. If you're saying, my kids only work for me during summertime, only for that 2 months, and I'm gonna pay the kids $60,000 for just work for that 2 months. I mean, and by looking at what the kids do for you, that may not be sound reasonable. So if you get out of it, the IRS may have a problem, because well, if you hire an independent person at similar age, similar skill set as your kids, but if you're only paying the minimum wages, but you pay a lot more to your kids, then you're just trying to shift income to your kids. So you got to be careful on that. So make sure that the compensation you pay to your family member is reasonable. The kids are just one of the example. I have a client, they also hire parents to do some work for you. Again, just try to take advantage of the parent has a lower rate because they are retired. But again, you want to make sure that you look at what type of work they do for you, their experience, their skill set, their schedule, and just pay them a reasonable amount. And also hiring your kids might be a good way for them to start learning your business, kind of get them into the door if your goal is to pass on, grow your business and pass on to the next generation. Having them start involving in the business earlier is better. Next, I'm going to just go over some of the retirement plans that may be available to you as a small business owner. So now we have a lot of, or most of the clients have the 401k. Now you can have a traditional 401k. You can have a Roth 401k. Being a small business owner, you can have a SEP IRA. You have simple IRA. So this is all the retirement plan you can consider to defer your taxes. Again, having a qualified retirement plan is a deferral strategy. And then also we have the Security 2.0 Act that was just passed last December, and that make a lot of changes to the retirement account and retirement plan. So definitely talk to employee benefit services. We offer that service as well, or talk to somebody who can help you to come up with a good retirement plan. Again, it's a very good tax deferral tool if your business you have a very good year, making a lot of profit, and you want to save some taxes that reduce your tax obligation. This is something you can consider to implement for the year. And also they changed the rule before before the rule change, you have to implement or you have to set up your retirement plan before end of the year. So let's say you have a calendar year end, you have to set it up before December 31st. But now you actually have additional time to set up your retirement plan. Next, I'm just kind of quickly go over some of the tax incentives that's available to the small business. The first one is the research and development tax credit, the R&D tax credit. So if you are either like a technology company, you develop, like you do some of the software development, or you're a manufacturer, you have some R&D activity, you can take advantage of this R&D credit. So the R&D credit in general is an income tax credit. So if you qualify, it's based on the wages you pay to your employee who are involved in the R&D. So the R&D credit involves it includes the three components: the wages, the supply, and the outside consulting fee you pay for it related to the R&D. So if you're developing a new product or a new procedure, you have R&D activity, you can claim the credit on the wages you pay, the consulting fee you pay, and the supply you purchase for the R&D activity. Normally, that's an income tax credit. However, if you are a startup company, a small business, and you're not really making any taxable profit yet, you can use the R&D credit to offset your payroll taxes. You probably heard about this. There's a new law passed last September, the Inflation Reduction Act, IRA. Before the Inflation Reduction Act, if you are a startup company, you're a small business, and you had R&D credit, you can only use up to $250,000 R&D credit to offset your Social Security tax, your FICA. But that got changed after the Inflation Reduction Act. Now they double the maximum amount of the R&D credit you can use to offset your payroll taxes. So now the limit is $500,000, and that can offset your Medicare taxes as well. So that can be a very great benefit for small business if you qualify for the R&D credit. That basically then you can not paying any payroll taxes for the year. The second incentive that you can consider is the California Compete Tax Credit, especially for small business or startup company. Your gross receipt is under $2 million. We have this program available in California. This Compete Tax Credit is to encourage business to hire more people and buy more equipment or have the capital expenditure in California. So basically, the California Compete Tax Credit is looking for credit. So if you want to apply for the credit, there's no fee required to apply for the credit. You can just go to the website. You can submit the application online. And basically, when you apply for the credit on the application, you have to provide your forecast, your projected increase in your employee headcount and your projected capital expenditure for the next 5 years. And based on your projection on your increase in the labor cost and the increase in your acquisition, your purchases of all the fixed assets, then you calculate how much credit you can potentially you can apply. So the minimum credit is $20,000. There's no limit on how much credit you can get, but of course, the credit is calculated based on your projected investments. So the more investment you have, and the higher credit amount you can apply. After you submit the application will be reviewed by the committee, and then then it's up to them whether you will get approved or not. Let's say if you get approved, you can choose to how you allocate your credit. You can allocate a credit evenly over the 5-year period, or you can allocate a credit to just the first few years when you're going to start growing your business. Of course, this is looking forward credit. So when you put it on the application, it's just a projected number. So after you finish that year, and you have to kind of look at your headcount, your employee headcount, and look at your fixed asset purchases, and you have to confirm or submit the form to the state of California, say whether you meet the milestone or not. So on the application, let's say, for example, if I tell California I'm going to hire 10 more people in 2023, at end of 2023, after the year end, then I have to fill out this form to tell California, did I actually hire 10 more people or not? If I did not hire, well, if you're off just at one headcount, it's, you can probably still are you eligible for the credit. But if I tell the California I'm going to hire 10 people, but I only hire 2, I didn't meet my milestone, then I won't be able to claim the credit on my tax return. So you need to make sure that you meet your goal, your milestone, before you can claim the credit on your tax return. There's also another catch, is that, let's say I hired 10 people in 2023. I made my milestone. I met the goal as I put on my application. However, in 2024, soon after I claimed the credit, I laid off a bunch of them. So if I hired 10 people in 2023, but I laid off 8 of them in 2024, then there's a recapture. So if I claim the credit on my 2023 return because I meet the goal, but then I end up laying them off, I actually have a reduction in my headcount, then I have to pay back the credit on my 2024 return. So that's just something to keep in mind. Also, for a small business, we talk about the retirement plan. It's a good idea if you have a good year, you're making a lot of money from your small business. For tax saving purposes, you set up this retirement plan, then you also get a tax credit for setting up a retirement plan. So that'll be something that you can consider, and definitely talk to your CPA, your tax advisor, and make sure you claim all the credit or taking advantage of those incentives if you qualify. That pretty much concludes my presentation, and this is my contact information, and I'm also happy to share my slide with City of Glendale. And if you want a copy of my slide, you can contact Hurry, and then she can share my PowerPoint presentation with you. But this is my contact information. Feel free to call me or email me if you have any question. I'm a tax expert, so I'm happy to help. And also, I also have some information at the end of this is my bio, and also here's some background information about our firm. We've been around for 97 years. We have 200 professionals, and we have 3 offices, but the one in LA is more a satellite office. So mainly Long Beach and Irvine. We cover LA and Orange County, and we do audit, tax, and employee benefit services. But we also have audit advisory services. So if you're interested to know more about our services, feel free to reach out to me. And also, this is just some of the award we got. So that's all I have. And I'll just see if anybody has any questions. And I'm happy to answer any question people have.
Thank you very much, Bella. That was very informative. So if you'd like a copy of Bella's slides, I put my email into the chat. Let me know. Happy to forward it over to you. And if you have any questions while we have Bella here, please feel free to unmute yourself or put it in the chat, as we'll take each question. Mindy, any questions?
Yeah, I look puzzled. Okay. Yeah, my question was about the section 199.
Yes.
Qualified business income deductions. Oh, there's my answer. Okay. All righty. So what services are they including in that?
Yeah, so the specified services include accountant, lawyer, doctor, physician, or you basically are, or like a financial advisor, or you selling your personal, your specified skill. Like, if you are, even like if you're a chef in a restaurant, but you're, people come to the restaurant because you make a very good food, and that can consider a specified services. But mostly it's professional services, like like I
So
said,
bookkeeping
lawyers.
would be under that, right?
Yes, yes, unfortunately. But this one actually excludes engineer. So like it's engineer and architecture, they can take the 199A deduction. So, and the 199A deduction, the 20% deduction, also because I have a lot of clients as a real estate investor or real estate owner in California. So if your client is getting rental income from their real estate investment from their income producing property or investment property, they can also claim the 20%, the 199A deduction on the rental income. But unless it's a triple net lease, you cannot claim the 199A deduction on the rental income if it's a triple net lease. That means you don't do anything. The tenant paid for anything. You don't really managing it. Unless you are in the the real estate activity is your trade or business. I do have a client that they just buy property all the time, but that's their trade or business, then they can take this 199A deduction. Yeah, unfortunately, bookkeeper, accountant, we didn't do a good job in lobbying. That's not really in Congress, so we got excluded. Yeah.
So Bella, you mentioned that the tax deadline got extended to May 15th.
Yeah, so California, because we have a storm earlier in January, so the IRS extend the tax deadline for most of the California individual or business until May 15th. So you don't really need to file any tax return or pay any tax until May 15th. Of course, if you are expecting a refund, you still want to file them quickly to get your money back. If you owe, then you don't have to pay until May 15th. But being a tax professional, since COVID, we've been dealing with, the first year of COVID, they extended the deadline to July 15. The second year, they extended to May 15. Last year, finally, we have a April 15 deadline, and this year, they extend the California deadline to May 15, but we still hope to get everything done in April. So, all our tax professionals can enjoy or take some time off after, end of April.
Well, yeah, most tax preparers and accountants, they have their vacations already planned for 2-3 weeks after April 15th.
Yeah, so our goal is to get everything done, just like assuming there's no extension for the deadline, and people can just take a little break after April 15th. But yeah, I definitely have colleagues, they already make the vacation plan in early May. But definitely encourage people to just get that done on time. Don't be a procrastinator. Like I said, especially for a small business owner, my experience is that they tend to be a little bit unorganized. So, and then of course you're probably gonna have a question like, I think earlier Mindy and I, we share like, oh, what was a good question? Can I deduct can I expense this? Especially when you get to like the meal, entertainment, and keep in mind for 2022 you still get 100% deduction for your meal, but for 2023 it's going back to 50%. And for meal, it has to be like a restaurant or it can be a to go. The 100% deduction does not apply to if you're buying stuff from Costco. If it's just a convenience store, the grocery, even for your business, for your office supply, you cannot get 100% deduction. But that got reduced back to 50% in 2023. But I always tell a client that make sure you keep your receipt. You need to have a log. Like if you have a lunch with your customer, with your vendor, supplier, just document it on your calendar. Say of course
you have to know who you were eating with.
Yeah. And then again, with a lot of app out there, it's probably easy. And beside meal, also mileage. I have a client say, I use my card for business and personal, but how do I deduct it? I say, well, you need to have a mileage log. Say, this day, of course, if you have an office, any commute from your home to the office is personal. From office to seeing a customer or a vendor business partner, then that's deductible. Unless your home office is your office. If your primary business location is your home office, then from home office to seeing your business partner, your customer is deductible. But you need to keep a log. There's a lot of app out there. I know. You can just keep track of your mileage, and for the meal, just take a picture. Save the receipt. Put in the somewhere.
So what if, okay, so if you buy yourself lunch and it's just your lunch and it's between clients, that's still personal, right?
Correct.
Okay, now if you're traveling, if you're at a trade show and you have lunch, that's a travel expense
Yes,
or personal?
that's a travel expense. That's
Okay.
travel expense. So, and when you talk about you just feeding yourself, yeah, if it's just you, that's personal. But if it's you and your client or you and your colleague, you guys have to lunch because you have a meeting. So let's say we need to have a meeting from 11 to 2 o'clock. In between, we need to keep everybody here. We need to go continue to talk about business. So we order lunch in. That whatever the lunch you provide to the employee for the employer convenience, then that's still considered a business meal.
So and if you're in the trades and you're paying the crew lunch, that's business deduction for 2022.
100%. Yeah, but if you are in the trade, but like at convention, if you're out of town, so
No, I'm talking about they're electricians and they're paying the electricians on a job because they did such a great job, so they're taking them out to lunch.
I'm sorry. Yeah, the crew. Yeah. I mean, for 2022, it's all 100% deductible. For
Nice.
2023, we'll go back to 50%.
Great.
And,
But also,
what about third-party food deliveries? Like, let's say someone's post-meeting lunch for a meeting in the office. Is that deductible?
100% deductible in 2022, 50% deductible in 2023. The only thing that in 2022 is 50% is only like if you just buy stuff like snack from Costco. So, our office, we do have a snack. We have a weekly delivery from Costco. If you're buying Coke, soda, snack, cookie from Costco, that's only 50% deductible. And then also make sure, again, just talking about meals is always the favorite topic. Let's say you take your customer to a Laker game, a Dodge game, or Angel game. So there's a entertainment component including that event, and there's a food. Make sure you get 2 separate receipts because the entertainment is not deductible for federal, 50% for California, but the food is deductible. So make sure you separate them.
So the Dodger tickets are not deductible.
Not deductible.
Okay.
The other interesting situation that you may also have a client who sponsor a charity event. So the charity event, there's probably some like golf involved in the charity event, but if you pay, somebody to go to the golfing, that's not deductible, the entertainment. But anything you pay more, it can be considered a charitable contribution. The other example will be like a dinner or a gala, or getting a table. If you're involving a charity, and then they have an event. So let's say, regular ticket, you just go there for a meal, it's only $50, but you pay $100 per person. That additional $50 can be deducted as a charitable contribution.
Okay, so if I got invited to a bingo, and burgers and drinks are included, so and it's for a nonprofit fundraiser, so $15 for the meal and the rest is a deduction.
Again, I think how you're gonna see it if you go to the bingo because for a business reason, I would say kind of like the food and the beverage is deductible, but and then the rest, whether it's entertainment or it's a business development. Again, how you see it. Really, I think from the bookkeeping standpoint, it's just how you're gonna record that, right? I mean, small amount. Sometimes the client, I know they just like call it business promotion, marketing expenses, and not limit themselves to that entertainment deduction. But just how you record it. But of course, you want to, if you don't get out of it, I mean, it's small amount, so any risk or exposure might be small, unless it's like a big entertainment expenses that you want to expense it as a marketing expenses, then you may have a problem.
Yeah. Have you seen how expensive concert tickets are now?
Yeah, yeah. Yeah, everything is double or triple the price, so the cost definitely go up. Yeah, even the food, the meal, I always say, yeah, if you go to a restaurant, it's not, at minimum, it's probably 20 or more per person, including, after tips and tax. Yeah.
Are
But
tips deductible?
I'm sorry?
Tips for meals or valets, or is that deductible?
I would include that as a part of your meal expense. Yeah.
Okay.
But again, I think my recommendation for all the small business owner out there, the best practice is have a good documentation. Everything you deduct as a business expenses, you have to keep the receipt, have a good record. Again, of course, nobody likes to get audited, and you're not gonna have any problem if you don't get audited. But if you get audited, that'll be the auditor they want to see. They want to see all the support, the receipt, invoice, proof of payment, and to make sure that's legit, that's ordinary and necessary business expenses, and that can be deducted. So keep a good receipt, good record, and have a good accounting file, good QuickBook file. So everything is transparent, and that really can save you from any issue if you get audited or in the long run, even from the business perspective.
Yeah, I know. I have some colleagues in Canada that, in Canada, you have to have your receipt for absolutely everything because you need to take the sales tax off of it.
Yeah.
Reimbursed for it. And so a lot of them use Dext, DEXT, used to be Receipt Bank. And so they take a picture of it and it uploads into QuickBooks Online.
Okay.
And so it's there.
Yeah, I know there's a lot of app out there, online website or portal, or a lot of program out there that make the documentation easier. You really don't need to have that paper on hand, and IRS accept all the electronic receipt. So you just need to take a picture, upload to the app, to the cloud, and that will be your documentation. I know some of the country, they even require you to submit your financial statement with your tax return. Of course, we don't have that requirement here, but you need to have a good setup book in order to know if you are making money or not, and also, keep yourself out of trouble if you get audited.
So I have one client that they don't keep any of the receipts. It's all on their card, so they think that's enough.
Because if you look at the credit card, if they use they pay all the business expenses by using their credit card, but there's really no detail on the credit card statement. I mean, if you just think from the IRS auditor perspective, if you say, "Oh, I just pay my software due, for $1,000 for the whole year," but how do I know that's for business or personal? That's why you need to have the invoice. You need to have the receipt, because that's what you need to prove to the auditor that I do pay this for my business and it has legit and business purposes. If not, then definitely they can disallow the deduction, and then you'll have to pay the tax back to the government.
Okay, good news.
All right. Well, I know we have a small group, but hopefully, we can get together next time for the next workshop, and and then you have my contact information. Feel free to reach out to me if you have any questions. Thank you for having me today.
Thank you for joining us, Bella. And yes, since the deadline did get extended to May 15th, my hope is to have another webinar for tax preparation, just as a refresher, maybe in a month and a half, for those who are in need of a refresher, of course. But if not, I'm going to make this video available online on our YouTube channel and our chooseglendaleca.com website. And yeah, so I'll be in touch with everyone with new webinars. We have one coming up next week, next Thursday. It's called Access to Capital. And that's also on our Eventbrite. If you'd like, you can email me. I can share the information with you as well. With that said, thank you so much for taking the time to join us today. And thank you, Bella, for this insightful webinar. Thank
Enjoy
you.
the rest of your day. Thank you.
Have a
You
great day.
too.
Bye.
Bye.
Bye.